Welcome to the Digital Lending and Account Opening 10 Predictions for 2021 and Beyond, a webinar presented by Jim Marous, co-publisher of the Financial Brand and owner and publisher of the Digital Banking Report. My name is Kevin Fleetwood, Marketing Director for MeridianLink, and I will be moderating this session. Feel free to ask questions in the question box, as Q&A will be available towards the end of the presentation. We have 2 poll questions and a survey, so we appreciate everyone's participation. One lucky attendee will win a $100 Amazon e-gift card, so we will announce that winner towards the end of the presentation. Also, please take our survey, as one participant will win a $50 Amazon e-gift card. For those new to MeridianLink, we are a provider of cloud-based software solutions for financial institutions, including banks, credit unions, mortgage lenders, specialty lending providers, and consumer reporting agencies. MeridianLink connects to over 1,700 clients and their customers to better financial experiences through digital consumer, business, and mortgage loan origination, account opening origination, collections, business, consulting, and analytics. Further information can be found at www.meridianlink.com. Jim Marous, our presenter today, is consistently rated as one of the top 5 most influential people in banking and one of the most sought-after keynote speakers for industry and corporate events. Known for his understanding of the disruption in the banking industry, Jim is the co-publisher of the Financial Brand and owner and publisher of the Digital Banking Report. Jim speaks on innovation, digital transformation, customer experience, marketing strategies, channel distribution, payments, and change management. MeridianLink has partnered with the Digital Banking Report on its financial research and has sponsored the Digital Lending and Account Opening Report for the last 3 years. At the end of this webinar, we will show you how to get a complimentary copy of the 2020 report published last September, which sells for $495 on the web. You can also click a link that is in the chat box, which will also allow you to get a complimentary copy of that review. Before I turn this over to Jim, let's take a quick poll just to get a feel for where your organization in the area of digital lending and account opening. On a scale of 1 to 5, please rate your current digital lending and account opening programs. 1, poor, we need serious help now. 2, below average, we try but lack commitment. 3, average, we try but need more focus. 4, above average, we see constant improvement. And 5, great, we rank right up there with the big players. We'll keep the poll open here for just a little bit longer as try to hit that 50% mark or higher. And right now, it looks like almost half of the people are averaging themselves a 3. Average, we try but need more focus. About 40% consider themselves above average. And 2% consider themselves great, while another 2% consider themselves poor. Interesting results, and I'm sure Jim will address those later on. Again, just as a reminder, the predictions and opinions expressed in this webinar are those of our presenter, Jim Marous, and not necessarily those of MeridianLink Inc. or its staff. Views and information expressed are solely those of the presenter delivering the content. So now I turn this over to today's digital lending and account opening prognosticator, Jim Marous.
Thanks a lot, Kevin. It's great to be here today. And you know what, I think as we start off, especially with that disclaimer, really what we're going to be talking today is, while we're talking about predictions, the reality is what we're really going to be talking about are priorities. Each one is a priority, but I'll emphasize the ones that I think will make the difference between a so-so year and a banner year with regard to digital lending. I think one thing that we know for sure is whoever made predictions last year, we were probably wrong because everything changed in an instant more than we ever thought would happen. And I think one of the predictions that I can certainly make without any question is that change will continue to happen as fast or faster than it ever has. And that the reality is change has never happened this fast and it will never happen this slowly again. So playing catch up is not a winning strategy in much the same way that waiting and maybe being an early follower or fast follower is not a winning strategy. And in fact, when we look at the first prediction, speed is more important than ever. And that means speed in engagement, speed in deployment, and actually overall speed in application. So what we found was in 2020, organizations on a massive scale started offering digital loan applications more than ever before. And in fact, we had almost a doubling of organizations that said they offered digital lending. Unfortunately, and this is really where the rubber hits the road, while we had the ability to do so, we aren't doing very well when it comes to doing it in a digital manner, the way the consumer would expect it. Now, what does that mean? When we looked at how long does it take to complete a website or online consumer loan application, we actually had a longer period of time than we did in previous surveys. Okay, so while some people did it in a short amount of time, on average, the average was actually higher. And in fact, over 50% of organizations had a situation where that it was more than 5 minutes. In fact, 85% of organizations took more than 5 minutes on a web application. This is unacceptable in a world where our competitors, our fintech providers, more than ever are finding faster and faster ways to complete an application. In fact, in retail stores, credit is now being offered in a buy now, pay later scenario on site instantly. Any of you who have applied for an Apple credit card will find that the process is so simple, so quick, so easy, so seamless, so devoid of friction that it's actually enjoyable to go through. We, more than ever, as financial institutions, have to upgrade the ability for ourselves to be able to process loans and take applications quicker than ever before, or else the consumer will disengage from the process and abandon their shopping cart. Now, what happens is, while you may have been the first choice, it is very possible that if you take too long to get the consumer from the start to the finish, they will abandon and go someplace else. And the number two choice may very easily be a fintech firm or a top 5 bank. The second priority, or the prediction, is that friendly is no longer an issue of how good is your branch staff. In reality is most consumers, the vast majority of consumers, have not even walked in a branch since last March. And if they've done it very quickly, or they've done it in an indirect manner. So what does that mean? It means that to be friendly in a digital environment means you're going to help the consumer get to where they want to be in a painless way with engagement tools that make it easier than ever before. In addition, you'll allow them to switch channels. You'll allow them to maneuver naturally through the process the way they want to do it. There's a lot of cases when a consumer will not have all the information they need to do a complete app. In those cases, we have to allow them to stop the process and then restart it. Or complete the process on another channel. What we found that in 2020, there was a great increase in the number of organizations that said, if we had a digital loan application process, that we can complete the entire process without a visit to the branch. Still 27% said they still hope to do it, but within a year. 5% have no plans. If we make them go to another channel, they will most likely leave the process because every day, more competitions in the marketplace that says we can do it all on a turnkey basis, either on a website or online or with a mobile device. So again, what we need to do, we have to fix the internal aspect of our loan application process to make it for a digital environment. We don't need to do all the steps that we've done before. As I mentioned earlier with the Apple Card, you find that the first screen that they give you is all the information they know about you and say, just validate if it's right. How much easier is it to validate something is right, almost like every retail app in the marketplace, than to have to fill in all the detail? I mean, think about the last time you engaged with any firm digitally. It is very unlikely you had to fill in all the data. You may have had some options, but you didn't have to type in your name, your address, your city, state, zip code. We have to make this a painless process. This is how consumers define friendly. In addition, if you're waiting for the consumer to want to come back to the branch to engage on a process like new account opening or digital lending, it's not going to happen. The reality is, more than ever, the consumer is understanding they should be able to do anything they want without having to meet face to face. The third prediction, simplification can never get too simple. So what does that mean? Organizations have to work within their organizations to say, how can we do things differently? How can we build them differently to enable a digital engagement process similar to an Amazon or a Google or an Uber or an Acorns? Organizations really must remove steps from the process to allow their consumers to maybe, for instance, save and resume, jump to another channel. Right now, according to our research that you can get by downloading the report, you'll see that if a person starts on a website, only 33% of the time could they restart it in a branch. 48% can stay on the same channel. But when you start looking at things like mobile or tablet, you're down to 18%. That means if I went from my house to a online app and then wanted to use the phone, it's very unlikely I would probably have to start it over again. It's the same way if a person started on a phone and wanted to work the other direction. This is unacceptable in a world where consumers use an Instacart, Zoom, and applying for loans and for new accounts digitally. The fourth prediction, and this is a really important one. We need to use the data that we have on file to make the process simpler, easier, faster, and more friendly. We need to use the data we have internally to simplify the processes, to anticipate opportunities, and to generate better experiences. In our 2021 Trends and Predictions report, which is about to come out in another week, the number one goal of every organization is an improved customer experience. However, to provide that level of experience, it's more important than ever to use the data that we have at our fingertips to help the consumer know that we know them, understand them, and will reward them. Now, what does that mean? It means We can't use data just for great internal reports. I mean, I know I work with a top 5 bank right now in my personal account. I know that that bank knows more about me than I ever would believe they know about me. The problem is they don't use it to show me that they know that. In other words, instead of making good reports, you need to use data to make great experiences. You need to use data to fill in the gaps about the know your customer and the KPIs. You also have to use it to build a profile on the consumer. You should know where they are on their journey and when's the next time they may need a loan. If you see balances continually being depleted out of their checking their savings account, they probably need a loan. If they've already applied someplace and the credit bureau's been pulled, it is very unlikely that they're getting whatever they want that day. So, for instance, when I went to buy a car, when I do a test drive, they're doing a credit bureau on me. You, as a financial institution, would know that I'm looking for a car loan. You can reach out to that consumer that's your consumer before they look for other options and say, hey, if you're looking for a car or looking to refinance your house, we have loans that are going to be perfect for you. Just click here. What's even more important is when you start to use data on a scaled basis to provide proactive solutions that the consumer may not even know they need. This is data maturity. This is moving from simply answering phone calls or applications that come in to actually helping the consumer understand there may be a better option out there. The fifth projection is that overall, your internal culture needs to change. Your internal culture needs to reflect a digital perspective. If you continue to do banking or be a credit union executive in a legacy manner, you will build legacy systems that are not responsive to the speed and the needs of the consumer. When we asked organizations, what's the most important component of change right now? They mentioned digital transformation. The foundation of digital transformation is being able to have a culture and leadership that is not only open to change, but overall internally encourages and incentivizes change and embracing it. Most of your organizations have large teams of people on the customer care side, in branches, in the call center, and elsewhere. They all feel threatened by digital banking. They feel threatened by the possibility that a person is going to take a loan application on their phone as opposed to coming to the branch. They feel threatened that all transactions may go digital and they'll be out of a job. And the reality is, that's the furthest thing from what should be the truth. The ability to look and find opportunities in the marketplace, to service consumers, to give them the heightened level of digital experience is the human factor. But that human factor is only possible if you provide the culture and the data and insight to allow your customer care people to actually help the consumer in the process. So as I mentioned earlier about data and analytics, simply giving the whole team, oh, by the way, here's what we found out about consumers is not right. What you need to do is say, what does this mean? What is this customer really looking for? How can we help them? By engaging your own employees, your own teams in the process, what you will do is you'll actually help them sell to the consumer, actually help them solve financial challenges that a consumer may have. You will also make it so employees start to reinforce your digital transformation journey as opposed to working against it for fear of their own job. This overall will greatly improve the customer experience. Prediction number 6. What you need, and I referenced this earlier, you need a updated GPS of financial services. Now, banking traditionally always tells consumers what's already happened. By the way, Jim, you have a overdraft that already happened, or you have a balance that fell below a level, already happened. The consumer no longer wants the rear view mirror view of their financial relationship. They want you to provide the GPS of financial services to predict what they will need next, to help them be a better consumer, to make them a better financial steward. They want a financial concierge that'll help them move forward in the way that they should. Unfortunately, when we did surveys as to if on the basic level of data, so if you took into account how much business they currently had, and we said use data to determine what's the next most likely product the consumer should have, we believe that's basic. 75% of financial institutions of all sizes say they were inept at being able to take data and know what the customer should have next, what the next best action is. That's the basic level of data application. That is something we all should be able to do. And it actually gets worse the smaller the organization is. So what we have to look at is say, how do we make this better? How do we work on behalf of the consumer to say, by the way, it might make sense right now, given that loan rates are so low, for you to borrow this money and keep investing in the market if that's what you're doing, because you'll make more than it will cost you in your loan. Or if a consumer is struggling right now and they need a bridge loan for a short-term need, are you there when they need to be? I mentioned it in a lot of sessions, the fact that I have a small business account, and my small business account, my receipts come in through PayPal. My payments to my contractors go out to pay through PayPal. As a result, PayPal has all the information they need to be able to offer me pre-approved short-term loans, bridge loans for my business, and they do so. Now, my balances are actually held at a traditional bank, but they not once have come to me and said, by the way, Jim, because of your business and the level of business you do, we're more than willing to offer you a pre-approved line of credit. Never done that. And in fact, if I wanted that pre-approved line of credit, it's very likely that it would take 3 to 5 days. I may not get approved. And the rate's not going to be that much lower than what it would be for PayPal. And actually, if I'm looking for a short-term loan, I'm not worried about the interest rate. I want it now. I want speed. I want accessibility. We have to think about that when we look at the fact that I want you to be aware of where I'm going as a customer, and I want you to be there on my behalf. Prediction number 7, and I mentioned this earlier as well. Staff will make the difference between great and average. What I mean by that is, if we deploy the insights that we have to our employees across the organization and tell them what to do with, they will not only feel part of the digital process, but they'll improve results. In fact, MIT Sloan found that the further the data gets throughout the organization, the further the AI gets, the further the insights get, the greater the revenue that's generated, because you have more people helping leverage that data for a better experience, for more sales, for better GPS of financial services. What we really have to do is say, the data that we have is everywhere. We've got to get it out of the silos, even if it's not perfect, and use it to build relationships. Even outside data, credit bureaus, when a person does a credit report, we need to be able to take that data for our customers and say, these people are obviously looking for credit. How can we help them before anybody else reaches out to them? Prediction number 8, your busiest branch will be held in your hand. This is an important one because you keep on hoping that the consumer is going to come back to the branch. The reality is it's not going to happen. Some will, But most consumers are more and more, the longer we go on with the COVID situation, it is more and more likely that they're going to start on a phone or an online tool first. And when we're asked, geez, which should we build first? Should we build the online web application or the mobile application? That answer has changed over the last 2 years. Now more than ever, put to the side whatever upgrades you want on the web and start with a mobile device. Because if you get the mobile device right, turning on the web is easy. If you get the web right, many times you haven't done enough for the mobile consumer. So the consumer expects to basically be able to apply and get credit on any way, shape, or form on any type of loan using their mobile phone. Digital is no longer just for the young. In fact, the biggest increase in digital usage over the last 12 months has come from the most senior segments. Consumers expect to be able to get an auto loan, an unsecured loan, a credit card through a mobile device. What's even more important, they're increasingly expecting to get a mortgage loan because of organizations like Rocket Mortgage, a student loan, a small business loan on a mobile device. And not just be able to, but be able to in such a way that is easy, fast, and devoid of friction. Prediction number 9, digital access will grow exponentially. In other words, the awareness of the ability to get a loan digitally is going to even grow faster than it has over the last 12 months. And that awareness is across all platforms. We already know how easy it is to use Google to get an answer to our questions or Amazon to buy the product we want. But how about Netflix? What has Netflix taught the consumer that had never heard of Netflix before? Number one, foremost, they learned that Netflix, who has no relationship with me, gets to know what I may want to watch next based on what I've already watched. What does that mean? That means they expect you, who has a lot more information, to know what I may want next based on what I'm already doing. Instacart. For any of you that have used Instacart, it continues to improve as you use it. It knows what you normally shop for, how often you shop for it, and they'll start providing you recommendations going, geez, do you want those cherry tomatoes you've been ordering almost every other week? Are you running short of toilet paper? You know, what does that teach the consumer? That teaches the consumer that your data that you're collecting should learn over time as well. Acorns. Now, we're not talking about deposit services here today. We're talking about lending. However, Acorns learns how to take money out that's in excess of your regular balances and put into savings. That's all for the consumer's benefit. And then they invest it based on how you want to invest it. I've never really done a real good job on savings in the traditional sense in the past. 2.5 years ago, I signed up for Acorns. I now have over $20,000 in savings in an account that has been completely painless for me. It's been taken out on a regular basis based on my balance levels, based on the time of the month, and knowing that I can get it back at any time. Zoom. What has Zoom taught the consumer? How fast and easy it is to engage. One click. That's why Zoom's the number one platform for engagement right now. It's one-click engagement. So as the consumer is getting educated, we have to realize we have to meet these obligations that all these other digital companies are doing, even as non-digital as your local restaurant. That right now you can sign up for, you can sign up for Uber Eats, and get something delivered to your house, and you can reorder based on what you've ordered in the past. Prediction number 10, this is an important one. We are right now moving from a loan-based mentality that's very much traditional to a credit accessibility mentality. Consumers want readily available credit when they want it. This is what buy now, pay later has happened. It also is what it means is that overall, they want you to be able to tell them how much is available, either on a credit basis or an accessibility basis. How powerful would it be if you were able to take your entire customer base, continually credit score them based on their credit bureau, which you're doing, by the way, every moment of every day anyway, because of the fact you're trying to make it so that your safety and your risk is down. But how about if you turn that around and said, I'm going to take each one of my customers and find out how much data do I need to provide, let's say 80% of my customer base some credit. Now let's say it's only $250 or $500. That's not bad, because what you can do is put it on their mobile device saying, by the way, if you need some credit, we can provide it to you. And if you need more than what we can available, that we say is available right now, simply push this button and fill out some additional forms. Consumers value the ability to extend credit one way or the other and to pay it back as desired, as opposed to a set term. That's where the marketplace is going. The marketplace is making it so that credit, deposits, savings are all accessible on your mobile device and can transfer between accounts as you go along. This is your prediction for the future, moving from traditional loans to credit availability. So I think, Kevin, we have another poll question, do we not?
Yeah, we certainly do. And Ashley, if you'll go ahead. I would like to be contacted by MeridianLink regarding, and then make your choice from any of the four below: digital consumer business loan origination, digital account opening, digital mortgage origination, improving our digital lending and/or account opening process.
And while we're doing the survey, let me mention another thought, and that is, given the speed of the marketplace, given the needs of the marketplace, given the scope of digital banking transformation, now more than ever, partnering with solution providers is the best way to go, be it MeridianLink or any one of the other solution providers you may have. If it goes from new account opening to digital lending to any of the solutions that are out there that you need to become a digital organization, partnering is a way to go, because the partners have seen what your challenges are. Don't wait to say, I don't want to engage right now because my data is in a bad place. Organizations who can solve your problems for you have dealt with a lot of organizations that have data in a bad place. In addition, in almost every example I've ever seen, the amount of money and time that these solution providers can save you is far greater than the investment you're going to make in moving forward. Speed is of the essence. Catching up is more difficult than ever before, but this is where these solution providers, these partners, come in very handy. So, Kevin, what do we see on the survey?
Most everyone that has responded is really looking to improve their digital lending and/or account opening process as a whole.
So again, what it says is we all have room to improve. We really have to look at our internal processes. We have to dig below a nice, pretty app, because it doesn't matter how pretty it is. I don't want to look at anything in my phone that's pretty for more than a couple minutes. I don't know if that comes out even correctly, but I mean it to say nobody wants to go through an application process that's long and tedious. So do we have any questions?
Yes, we do, Jim. First one is, what is your opinion of bots and live chats?
You know what? Both of them are better than not active engagement. So I believe there's a lot of questions. What we've found in the marketplace is organizations use bots or pre-developed questions and answers for the ones that, number one, are the most overwhelming, the ones that you get the most, and the ones that don't need as much customization. When it comes to live chat should come into play for the more difficult questions. So I don't want to give a really rudimentary example, but if somebody's calling for a balance or did a check clear, something like that, a lot of that can be developed by bot or by additional questioning that can go on and move to a bot response. That takes a lot of pressure off a system that right now is completely dispersed across the marketplace because a lot of people are still working from home. Where live chat comes in, it's a great customer service addition for those that are not standard questions. The consumer does not mind bot answers to simple questions because it's fast. It's going to be faster than any other option and more painless. The live chat, interestingly, live chat, most people are going to prefer the typing in as opposed to face-to-face or verbal because people don't like their own voices. They don't necessarily, they're not always prepared for a live visual chat. So it's very important to look at that. So it's a balancing act. I think they balance each other off. I would not say one versus the other. They really have to work in tandem. And the more you're using data, the more AI that can be used, the better it can be. I mean, a good example is certainly Erica from Bank of America. The more and more that their active voice engagement is used, the better and better it gets. You've got to take that first step, though.
Jim, we're a small credit union and we're trying to figure out where to spend our digital budget wisely.
That's a
What are your suggestions?
That is a great question, and it's the one that I'm getting the most right now because, oh my gosh, digital transformation is massive. If I was asked, where would I put my money first? It is certainly what I call the front door of your organization. You've got to improve the digital account opening and the digital loan application processes. You've got to take steps out of it. It is far too cumbersome in almost every case. I mean, do me a favor. Open up the Chime app or the Current app or the Varo app or the Goldman Sachs Marcus app and try to open or engage at all. And in fact, Marcus lets non-customers open in relationships to some budgeting tools. But all these other applications, even start the process of refinance with Rocket Mortgage. It is insanely easy to get going, to get engaged, and to know where the dropping off point is. So the first place I'd spend money for any distribution, in fact, some people ask, gee, should I be looking at digital tellers in the teller system that are not human but are video tellers? I say, don't spend that today. That may be something in the future, and I may irritate some vendors that are advertisers or sponsor the financial brand, but the reality is your first priority has got to be to improve your web and your mobile apps to get a customer in the first place. Because right now, we as an industry, especially the small organizations, are losing far too many potential customers who come, start the process because you're top of the Google search because you're local, and then they disengage and they go to the number 2 slot. And that might be Bank of America, that might be Wells, that might be Chase, it might be the bigger bank down the street. So I would, without any hesitation, say you've got to put the money, but more importantly, the time, because a lot of the decisions have to be made with a circle of managers that all are involved in the process. And oh, by the way, when you bring this circle of managers together to say, how do we take this from 5 minutes down to 1 minute or 30 seconds? You're going to need everybody who has a stake in it, including legal and compliance, to help find the solution. And there are solutions out there. Organizations are doing it. I would also bring in your partners to help you get there. But first and foremost, that's where I'd spend my money without even a hesitation. We're losing too many accounts.
Jim, is there an financial industry cart abandonment rate? Also, are you able to break this abandonment down by product, auto, credit card, mortgage?
Interesting. We have gotten an abandonment rate is greater than 40%, but it is extraordinarily variable based on the institution. Imagine if I have a process that the abandoned, that I have a 1 minute or 2 minute application process, I have a low abandonment rate. If I simply took what was a very lengthy branch process and tried to make it so I could do the exact same thing on digital, my abandonment rate is well over 50%. In most organizations that we analyze, the abandonment rate is number one, entirely variable on how difficult the process is. And most people, credit card is an easier process. You don't ask as many questions. It's an easier approval rate, everything else. But overall, we're seeing between 60 and 80% abandonment rate. And what's difficult is when the branches were open, some of these people would have walked to the branch or gone to the branch to get that to say, you know what, your process was all messed up. I'm going to come to the branch to do it. They're not doing that anymore. As a result, these are true abandonments. In the past, you had a hard time measuring abandonment rate because what happened was they come into the branch would make it look like they came in without having started digitally, and they'll restart because we gave them credit for it. We gave the branch credit as an account opening or as a loan application, as if it never existed on digital before because we didn't trace it very well. As a result, we had a bad read on what the abandonment rate really was because we weren't keeping track of it. Now we're starting to keep track of it, and we're finding that it's significantly greater than 50% in most cases across all product lines. And the more difficult the loan, the higher the abandonment rate. And that's also, in most cases, the more valuable the loan.
Jim, what are some ways we can get staff to embrace digital?
There was an article I wrote for the Financial Brand just about a week and a half ago, talking about research that was done by MIT Sloan on the engagement of employees. If we engage employees from the very start, let them know what we're trying to achieve digitally, let them know what's going to happen to employees, let them know about how we will help train them to make them more adept at digital engagement, and most importantly, making sure they understand how important they are to the future, will do well. The retail industry taught us a really big lesson. When organizations started to offer digital products in a digital format or digital platform, the store employees found the digital side to be the enemy, and they did everything they could to undermine the process. In fact, the digital part of most organizations were totally the enemy. My wife is a retailer, and she moved from the store-based part of the business to digital, and they were starting to accuse her of taking customers away. The reality is the customer is going there. Now, the way they solve that problem is to make the branch employee, make the staff employee, make the customer contact employee part of the digital process, so they realize as they're learning that they will get better and better as being a supplement to the digital process, and they will not undermine the process.
Jim, is there a way to use text to help contact clients who are digital clients?
Boy, I love these questions because this one, I wrote about it this week on the Financial Brand. Text and SMS is the most underutilized communications tool we have. Now, we have to get an opt-in. We have to get the consumer to say, yes, you can contact me with offers and things that are for my benefit. We're not going to use it too often. Heck, we don't use email too often right now. In fact, we use it too little. When it comes to digital onboarding, when it comes to follow-up questions that are needed for a loan application, when it comes to offering them something that we see proactively they're going to need, text is so powerful. In addition, text combined with other rich media, text combined with video, text combined with an educational tool. These are all really powerful tools. And the reality is the click-through rate and the open rate is so much higher than email. I am amazed that we don't make this part of our application process to begin with. It says, by giving us your cell phone number, we will contact you as we deem important to keep you informed of what's going on, to offer you offers, and to give you alerts. The consumer wants them this way. We're less and less likely to open up emails because of the amount of junk mail we get. When consumers are sleeping, the first thing they do within 5 minutes of waking up is look at their phone. The first place they look is on their text messages. So I cannot say it enough. From a marketer's point of view, text messaging is the only way you should be communicating most of the things you're trying to communicate with your consumers. And it's so highly personal that you can guide them to where you want them to go and make it so that this simple, less than 160 character text can move them to where you want to go, from an educational tool, from a new account tool, or maybe to supplement their account because the balances are so low.
And Jim, we've got a whole litany of questions here. And if we don't get to your question, we will send your question to Jim and get an answer for you for all of these questions. Is it necessary to add additional fraud prevention to address the faster, quicker application process?
Actually, I'm not a fraud expert, but most of the digital tools that are available today have a fraud component put in place to do checks and balances. I mean, I'll give you a good example. I applied for an Apple credit card. Apple credit card had 6 things on the screen said, "Is this you?" And I said, "Yes." So I pushed yes. They asked for 4 digits of my social security number. They asked for my annual income. They asked me to read the rules and regs. By the time I push, I understand the rules and regs and accept them. They came back and told me I had a $10,000 line of credit on my credit card. Oh, by the way, if I wanted it, because you still had to authorize the fact that you wanted it. If I wanted it, I pushed yes. It immediately got to be the #1 card on my Apple Wallet. They additionally asked, "Do you want a physical card?" When I got the physical card, not only did they send it really nicely in a nice package, but on top of that, to basically authorize it, I only had to take my phone and put it to the card in the case, and it authorized it. That all took fraud to get involved in saying, how can we validate all this that it's Jim? It can be done. We've got to get out of our old thinking on all the elements we did to avoid any losses and start to say, how do we make it so we can take more customers in, build better relationships? It's a balancing act. And as I said, I'm not a fraud expert. I do know, though, that all these partners you have out here have enough fraud prevention expertise that can say, we can take all these steps away and still make it meet your fraud guidelines, your risk guidelines.
Jim, do you think that all online applications should have a save and return feature to help decrease cart abandonment, or enable a way to capture the email address so financial institutions can remarket to these consumers who show interest? And by the way, MeridianLink's Loans PQ does have save and return.
I think they're saying one or the other. I'm going to say both. #1, you need to have the ability to save and return. #2, and a great question, the way it was structured especially, the first things you want to capture besides the person's name is their cell phone number and their email address. Why do you want their cell phone number? Because you want to contact them via text immediately to say, can we help you walk through it? Because once you get a human involved, you're not going to lose them. That consumer is going to stay on that line for 5 to 10 minutes. That's what the time takes, and allow you to finish the process. It's a very important tool. With regard to save and resume, for those consumers that you can't get a hold of immediately, that ability to save and resume should be referenced to them. In other words, If they stop the process, I would still say, call us at this number and have it just simply a click and call, or you can save and resume and let them know what that process is. And then, more important than anything, is get back to them within 12 hours and remind them they have something that's still in the queue that they can go forward with, or they can push this number again and we'll walk through it with you. Yeah, I think so. It's a both. It's not an either or. You need both.
And to answer the follow-up question, yes, we do have save and resume in the application portal product. Would it be better for members to answer questions up front that may increase their application time, or have a shorter application that we have to follow back up to ask additional questions?
Great question again. I would say shorter, and let's make sure you have to answer all the questions. Too many times we are so stuck in our legacy thinking as to what we have to get from consumers that is available elsewhere, that we ask questions that the answers are already available through multiple data sources. Apple credit card never asked me where I worked. They just asked what my income is, and they validated it against my credit bureau. Credit bureaus provide so much data that to ask it again is simply old school. We don't have to keep on asking it. Now, getting back to the question, if I had an either or, I would certainly keep it as short as possible and then move them along the process so that you can get the follow-up questions answered later. And you can always have a contingent approval. But remember that the application is only part of the process. You also have to give them the loan or the credit very quickly as well.
And just to correct something that I misstated, App Portal doesn't have save and return. It will later on this year. And one other question here before we call this in. The market has obviously been very hot for mortgages, but how are organizations best navigating the potential for the cliff that could be ahead with all the financial hardships and ongoing pandemic we are facing? Any advice?
I'm not, honestly, I'm not qualified to answer that. I have the same question personally. What's going to happen going forward? I just refinanced a loan. It was coined as, when we started the process, yes, we have a digital lending process. I found out that nothing could have been farther from the truth. It was simply moving things to the digital, things like PDFs and such. There was nothing digital about it. It took us longer than it would have in the branch. But I'll be honest with you, to answer your question, I don't have an answer as to what's going to happen with the possibility of employment changing, the financial marketplace changing, and it's a cowboy country out there. I don't know the answer, unfortunately. I will not give you a prognostication on that one, because 12 months from now, you're gonna come back and go, well, Jim said. I'm not that good at this.
And with that, we have a whole bunch more, but a lot of these are very long. So we will get Jim to answer these questions for you and get back to you with answers. With that, we want to go ahead and announce our prize winner for today. But before we do have these references available. You can get a copy of the digital loan and deposit roadmap infographic. The link is also in the chat window. You can take the digital lending and account opening assessment. That link is also in the chat window. These are also available on our website. And as we mentioned earlier, to get that complimentary copy of the 2020 Digital Lending and Account Opening Review that we did with Jim's team at Digital Banking Report, you can click on the link in the chat window or contact sales support at MeridianLink.com. And now, Jim, our prize winner for today, we want to congratulate Daniel Herrera with Alta Vista Credit Union. You've won a $100 Amazon e-gift card. Our team will reach out to you with instructions on how you can claim your gift card. And if you have need of any more info on the topic of today or anything to do with digital lending or digital account opening, please reach out to your MeridianLink account manager, business development director, or again, just contact sales support at MeridianLink.com. And as a reminder, you're going to receive a webinar survey following this webinar. Please complete it and you will put yourself in the running to win a $50 Amazon gift card. We always value your feedback. And with that, Jim, we thank you again for a great webinar and your prognostications for 2021 and beyond. And thank you to all the attendees. We had a very high attendance today. We thank you for attendance and look forward to seeing you at our next MeridianLink webinar. Thank you.